Cement and Aggregates Group, PPC, has reported flat revenues for the year to September at 6.8 billion rand. Operating profit fell 13% to 2.1 billion rand. This excludes charges the group took on empowerment transactions last year, as well as a take-on gain from the consolidation of PPC Zimbabwe last year. Joining me with more is CEO Paul Stuiver. Paul, thanks very much for coming in today. And Paul, the numbers skewed a little bit by the empowerment charge you took back in 2009 because headline earnings were up 28%. If you strip out the IFRS charge, actually down by 15%, and that really just shows the headwinds you are meeting at this point.
Yes, I think we commented this morning that we're seeing the third year of declining cement demand. And although we've taken a lot of cost out of the business, it becomes more and more difficult as volumes go down to replace lost volume with improved efficiency, and you see some of that coming through in the numbers today.
You said the third year of declining cement demand. To what extent is PPC a lead indicator for the construction sector? Would you, when you start to see demand picking up, is that when we're going to see a resumption in construction activity?
No, I'm afraid PPC is very much derived demand. We take what the market asks, or we supply what the market asks. The lead indicators are usually dropping interest rates, the reduction in interest rates, things like increased car sales. And what we're seeing this time around in this recession is that a lot of the trends that we've had in the past, the relationships between interest rates coming down, cement demand going up, hasn't quite held. And we're seeing a much longer delay between improving leading indicators like interest rates coming down and cement demand going up, and it's actually quite worrying.
Any sign at all at this stage of improving demand coming through?
I'm afraid not. We've tried to second guess the market a number of times. We were quite hopeful after a very successful World Cup, and we didn't see the disruption during the World Cup that we thought. But since that time, the market has actually gone sideways again.
Okay, now you're feeling this in the cement and aggregates business, though you do point out in the commentary that your lime business has benefited from the recovery in the steel and alloys industry. 75% increase in operating profit, sales up 23%. This looks pretty positive. Is it continuing into the new year?
It does, and the lime business is an industrial chemicals business. It's focused mainly on supplying the steel industry. So it's really showing that we've had a good recovery in our steel industry. Volumes in the steel industry not quite back to where they were in 2007, but more or less at 80 or 9% of what they were. So lime benefiting from an increased volume produced by the steel industry.
He also points out that rural demand, strangely enough, has been resilient. Any idea why?
We have some ideas. I don't have the statistics to back this up, but we've seen a lot of social grants in South Africa moving basically cash into the rural areas, and we believe that some of that cash is finding its way, a percentage of it, into cement purchases. So we believe that a lot of the rural grants that we see have made the rural community, has made more cash available in the rural community, and that's somehow finding its way into cement consumption and cement demand in the rural communities.
Again, while South Africa and Botswana remain under pressure, Zimbabwe demand has been coming through. That's starting to taper off though, isn't it?
Yes, somewhat. What we saw in Zimbabwe is that in February last year, when they dollarized the economy, allowed the US dollar as legal tender, we saw a huge change in the economy in generally, and in particular in cement demand. It went from 5,000 to 7,000 tonne a month cement sales to today 50,000 tonnes. So a tenfold increase in cement sales over a period of just over a year. So the demand has climbed very steeply, but as these things happen, the closer one gets to a high volume, the demand does tend to flatten off. We see in Zimbabwe there's going to be an election, a general election, either late 2011 or early 2012. We expect demand in Zimbabwe to basically plateau between now and the election at the end of 2011 or beginning in 2012.
How about other African markets? I think you were sitting here during the bulletin when we had that EcoBank story, and they're talking about businesses moving out of South Africa across the continent. We know Pick n Pay is planning a whole bunch of stores in Mozambique next year. And there is going to be demand for cement. There is going to be infrastructure demand as well going forward. Are you capitalizing on that?
Not capitalizing yet, but we certainly plan to. So we've identified sub-Saharan Africa as a very exciting place to be long term over the next 10, 20 years in terms of cement demand. There are 1 billion people living on the African continent. Their cement consumption in terms of world averages is still very low. And what we see as industry develops, as infrastructure starts developing, invariably the demand for cement will go up. If you couple this with the size of the population in Africa, it's likely to be quite an exciting story going forward, and we tend to be part of that.
You were talking a little while ago about costs and how you're trying to tackle some of those. And of course, running machinery at night time in some of your operations, stopping plant operations during the winter peak tariff operations. And of course, you also have the new Hercules mill, which has been completed. And that is a much lower electricity using mill, isn't it?
It is. New technology replacing equipment that was 30, 40 years old. And typically, when you do these technology changes, you get up to a 30% saving in energy, in this case electrical energy.
So with your CapEx plans going forward, are you going to be looking at new technology and also cleaner technologies?
We do. We have recently announced a 3 billion rand expansion program in the Western Cape, which will again...
You scaled that back slightly though, didn't you?
Yeah, we scaled back the original plan, which was a 4.5 billion rand plan, but still a significant plan. And then the process, we're replacing technology that's 40 years old with technology that's brand new, and again, a 30% energy saving expected from that particular expansion.
How does that position you as a lower cost producer going into the future?
We are a low cost producer at the moment. One of the advantages we have is that our equipment, whilst it might be old, has been paid off. So that certainly helps, at the overall cost level. And then at the same time, doing some of the things you've mentioned in terms of our day-to-day operations, but also continually upgrading the equipment, making sure that it stays state-of-the-art, and keeping up with technology is basically the way in the cement industry to keep your costs down.
Prospects for the current year, because it looks like they are pretty uncertain at this stage.
It does, and I must confess to hedging our bets a little bit. As I said earlier, we have tried to anticipate the market a few times, but we've been proved wrong every time over the last few months. So what we're saying at the moment, that we simply don't know. It could go up, it could go down, it could go sideways. It's simply, in the short term, very difficult to call. And the wisest thing to say under the circumstances is that we're just uncertain about the short-term future.
Well, we'll hold you to that, Paul. Thanks very much for coming in today.